On July 5, 1991, a coordinated strike by regulators across 7 countries abruptly dismantled a $20 billion financial empire, exposing a shadow banking network that had operated in plain sight. In London, heavy glass doors were chained shut by authorities before the morning rush could even begin. Armed police secured executive offices in New York, confiscating thousands of ledgers and severing communication lines to prevent the destruction of critical evidence. Halfway across the world in Hong Kong, tellers were abruptly ordered to halt all transactions mid-keystroke, leaving customers bewildered at the counters. The Bank of Credit and Commerce International, known globally as BCCI, was effectively erased from the legitimate financial system in a single afternoon. This unprecedented global shutdown marked the beginning of the most complex regulatory failure in modern economic history. The immediate human panic rippled outward as a massive $20 billion institution completely froze overnight. Over 1 million ordinary depositors woke up to discover their entire life savings were suddenly inaccessible. These victims were not elite financiers who could weather a market fluctuation, but small merchants, immigrant workers, and local charities who had placed their absolute trust in the sprawling institution. Families suddenly found themselves unable to buy food, pay rent, or cover basic medical expenses as their accounts vanished behind locked doors. Small businesses, abruptly severed from their vital operating capital, faced instant bankruptcy and forced liquidations. The collapse was not merely a sterile ledger adjustment, but a devastating financial earthquake that shattered lives and destabilized local economies across multiple continents. To understand how such a staggering catastrophe occurred, one must look back to 1972 and the charismatic vision of a Pakistani financier named Aga Hassan Abidi. He recognized a profound, systemic imbalance in the international financial order. Western institutions held a strict monopoly on global capital, leaving emerging nations starved for the crucial investment needed to build their modern infrastructure. Abidi aggressively pitched a revolutionary alternative that would bypass this entrenched financial hierarchy altogether. He promised to create a truly international bank specifically designed to empower the developing world. By uniting the newly independent nations of the global south, he envisioned a financial titan that could finally challenge the traditional, centuries-old gatekeepers of Wall Street and the City of London. Flush with an enormous influx of Middle Eastern oil wealth, following the energy crises of the 1970s, the institution expanded at an absolute breakneck speed. Capital poured into the bank's unchecked coffers, fueling an aggressive campaign of international acquisition and political influence. Abidi cultivated deep, personal relationships with heads of state, prominent politicians, and wealthy royalty to secure his empire. Within just a few short years, the operation achieved a staggering, unprecedented scale that alarmed traditional bankers. The network rapidly grew to encompass over 400 branches spanning 70 different countries. Analyzing this rapid, unchecked growth reveals a deliberate strategy to embed the bank so deeply into sovereign economies that it would become politically and economically indispensable to its host nations. However, this massive international footprint was built upon a deliberate corporate maze designed specifically to evade official scrutiny. The architecture of secrecy began with the bank's strategic incorporation in Luxembourg. This tiny European nation offered incredibly strict banking secrecy laws, effectively shielding the ultimate holding company from invasive audits, international tax authorities, or meaningful government oversight. While the legal headquarters sat safely protected in Luxembourg, actual executive management operated thousands of miles away in London. Meanwhile, the most sensitive and lucrative transactions were constantly routed through opaque shell entities registered in the Cayman Islands. This fractured, decentralized structure ensured that no single regulatory body on Earth could ever see the complete, devastating financial picture. This deliberate fragmentation created the ultimate shadow banking system, an entity operating entirely outside the standard rules of commerce. By dividing its operations across dozens of jurisdictions, the institution ensured that regulatory oversight remained permanently fractured. A central bank in one country could only audit the local branch, remaining completely blind to the parent company's massive global liabilities. Because no single national authority possessed the legal jurisdiction to view the entire global balance sheet, the network operated entirely in the dark. Regulators were essentially examining isolated puzzle pieces, unable to perceive the broader, terrifying picture forming beneath the surface. This structural loophole allowed the organization to function as a sovereign financial state, unbound by the traditional boundaries of international finance. Within this impenetrable darkness, a thriving, highly lucrative ecosystem of illicit commerce quickly took root. The institution seamlessly transformed into the premier financial hub for the global underworld. Smugglers, black market arms dealers, and violent international drug cartels discovered a perfect, frictionless sanctuary for their illicit wealth. Branch managers offered bespoke, highly confidential services to these criminal syndicates, facilitating the silent movement of millions of dollars across sovereign borders. Briefcases of untraceable cash flowed through teller windows in bustling metropolitan centers, instantly vanishing into a labyrinth of offshore shell companies. The bank had effectively weaponized its own corporate complexity to launder the staggering proceeds of global crime. The profound consequence of this unmatched secrecy extended far beyond traditional criminal enterprises, reaching the highest echelons of Western governments. Intelligence agencies quickly recognized the strategic value of an invisible transnational financial network. The CIA and its allied counterparts actively utilized these shadow channels to secretly fund covert operations, arm proxy militias, and execute classified directives around the globe. By relying on this illicit infrastructure to funnel untraceable money to foreign insurgents and political assets, these intelligence services became quietly complicit in the corruption. They willfully turned a blind eye to the cartel cash flowing through the exact same ledgers. Geopolitical expediency effectively shielded the criminal enterprise from the very authorities tasked with dismantling international financial fraud. Yet, beneath this facade of untouchable geopolitical power, a fatal financial rot was quietly hollowing out the institution from the inside. Despite the massive, continuous influx of illicit cash from cartels and covert operatives, the core business model was fundamentally broken. The legitimate trading and lending departments were actually hemorrhaging billions of dollars in catastrophic, undisclosed market losses. Reckless speculation and unrecoverable, unsecured loans to politically connected insiders had created a massive, hidden crater in the corporate treasury. The outward image of a thriving financial titan was a carefully maintained illusion, masking an unprecedented internal insolvency. The executives faced a stark, binary choice: admit defeat and face global ruin, or engineer a monumental systemic deception. To conceal the missing billions, management initiated what would become the largest Ponzi scheme in financial history. Executives systematically created thousands of fake accounts, fabricating phantom loans to generate imaginary profits on their official ledgers. When actual cash was required to pay off existing obligations, they simply diverted unrecorded deposits from new, completely unsuspecting clients. These fresh funds were silently siphoned away to plug the massive, ever-expanding holes in their hidden balance sheet. The entire global network became a desperate, high-stakes juggling act, requiring a constant influx of new capital just to maintain the fragile illusion of solvency. The bank was no longer generating wealth. It was merely cannibalizing its own depositors to survive another day. The sheer scale of this deception stood in stark contrast to the vulnerability of its primary victims. While international arms dealers and cartels utilized the bank for illicit transfers, the core deposits came from entirely innocent sources. Small local governments in the United Kingdom and tight-knit immigrant communities across Europe trusted the institution with their life savings. They believed their hard-earned money was secure in a rising global powerhouse. Across developing nations, central banks placed their crucial national reserves into BCCI accounts, lured by promises of high returns and cultural solidarity. These ordinary citizens and emerging states were completely unaware of the grim reality behind the polished teller windows. Every dollar they deposited was immediately swallowed by the massive internal deficit. Their genuine wealth was unknowingly propping up a hollow, decaying shell. The first major crack in this impenetrable facade did not begin in a financial regulatory office, but in the sweltering heat of Florida. In 1988, United States customs agents in Tampa launched a daring undercover initiative known as Operation Sea Chase. Law enforcement officers posed as affluent money launderers, setting a complex trap designed to dismantle a notorious Colombian drug cartel. They fully expected to arrest street-level smugglers and mid-tier syndicate bosses. Instead, The undercover agents found themselves navigating pristine corporate boardrooms and luxury hotel suites. The illicit cash trail bypassed the usual underground networks entirely. It led directly into the vaults of BCCI, implicating several high-ranking international bankers. These polished executives were caught on hidden surveillance tapes, casually discussing the logistics of laundering millions in narcotics revenue. The Tampa sting delivered a devastating public blow to the institution's carefully cultivated prestige. Facing overwhelming evidence from the undercover operation, the bank officially pleaded guilty to money laundering charges in 1990. They agreed to pay a record-breaking penalty of $15 million. For a brief moment, it seemed the entire corrupt enterprise might finally unravel under the weight of American justice. However, the bank's formidable public relations machine immediately went into overdrive to contain the damage. Executives successfully spun the criminal convictions as the isolated actions of a few rogue employees operating in a single regional branch. This aggressive narrative control worked perfectly. The institution survived the scandal, temporarily keeping a much wider global regulatory failure completely hidden from public view. Despite surviving the American laundering scandal, the institution's relentless demand for fresh capital finally triggered alarms in London. The Bank of England, previously passive, grew deeply suspicious of the bank's true solvency and erratic cash flows. They decided they could no longer rely on the institution's self-reported financial statements. Regulators quietly commissioned a highly classified, independent audit by the accounting firm Price Waterhouse. This clandestine investigation was given the foreboding operational codename Sandstorm. Auditors were granted unprecedented access to the bank's internal ledgers, bypassing the usual layers of corporate obstruction. They began tracing the convoluted pathways of loans, deposits, and offshore holding companies. What began as a routine financial stress test quickly escalated into a frantic global hunt for missing assets. The resulting Sandstorm report delivered explosive findings that terrified British financial authorities. The auditors uncovered that the entire corporate culture of BCCI was fundamentally built on systemic deception. There was no functional separation between legitimate banking operations and outright theft. The institution was operating a massive internal market of fictitious transactions designed to baffle any standard regulatory oversight. Price Waterhouse concluded that the bank was not just struggling, it was entirely insolvent. Billions of dollars in depositor funds were completely unaccounted for, vanished into a maze of unrecorded loans and phantom companies. The auditors presented a stark, undeniable mathematical reality to the regulators. There was absolutely no legitimate way for the bank to ever recover the missing funds. The devastating truth exposed by the Sandstorm audit went far beyond simple embezzlement. The ultimate scandal of the Bank of Credit and Commerce International was a catastrophic, systemic regulatory failure. For 2 decades, international regulators had been thoroughly and legally outmaneuvered by a criminal enterprise, masquerading as a legitimate financial pillar. Analyzing the wreckage, financial authorities across different nations realized they had only ever examined isolated fragments of the institution. Because the bank fractured its operations across multiple jurisdictions, no single agency possessed a complete picture of its balance sheet. This deliberate fragmentation allowed the rot to spread unchecked, protected by a labyrinth of international borders and conflicting legal codes. Armed with this undeniable proof of insolvency, the Bank of England faced an impossible decision. Aga Hassan Abedi's creation was entirely beyond saving, and allowing it to remain open meant facilitating ongoing, massive financial theft. The only remaining option was to coordinate an immediate, unprecedented global termination of the banking empire to stop the bleeding. This grim realization directly triggered the synchronized raids of July 1991 that shocked the financial world. Authorities were forced to initiate a devastating banking collapse on their own terms, rather than wait for an uncontrolled implosion. By freezing assets worldwide, regulators deliberately crashed the very system they were originally supposed to protect and monitor. The sudden destruction of this financial titan shattered public confidence in the international banking apparatus. Ordinary citizens worldwide watched in horror as a supposedly legitimate institution evaporated overnight, taking their life savings with it. The illusion of safety provided by national regulatory bodies was permanently broken, leaving a profound, lingering sense of institutional betrayal. This profound breach of trust forced an immediate, harsh reckoning among global financial leaders and policymakers. The disaster proved that modern, transnational finance could easily weaponize its own complexity to defeat sovereign laws. The world suddenly understood that a bank could grow large enough to operate entirely outside the boundaries of human accountability and justice. In direct response to the collapse, the United States Congress passed the Foreign Bank Supervision Enhancement Act of 1991. This sweeping legislation fundamentally altered how international financial institutions operated within American borders. For the first time, the Federal Reserve was granted absolute authority to examine, regulate, and terminate any foreign bank branch operating in the country. Simultaneously, the Basel Committee on Banking Supervision implemented strict new international standards for consolidated oversight. Regulators were now legally required to designate a single, primary home country supervisor for every multinational bank. This structural reform was specifically designed to prevent future institutions from building a global shadow network in regulatory blind spots. While new laws reorganized the global financial architecture, the immediate human toll remained devastating and largely uncompensated. Over 1 million individual depositors across 70 countries suddenly found their accounts frozen and their wealth inaccessible. Small business owners, immigrants sending remittances, and local municipal councils were instantly stripped of their operational capital. The subsequent liquidation process became one of the longest and most complex legal battles in corporate history. It took more than 2 decades for liquidators to track down the scattered assets and begin distributing partial repayments. For many families whose life savings were trapped in the void, the eventual fractional restitution arrived far too late to undo the financial ruin. The sheer scale of the 1991 collapse permanently shattered the illusion that sovereign governments could independently police transnational finance. When the United States Senate released the Kerry Committee report in December 1992, the findings codified a chilling new reality. The investigation concluded that a decentralized, stateless corporation had successfully outmaneuvered the combined intelligence and regulatory apparatus of the Western world. Aga Hassan Abedi's creation had not just exploited loopholes, it had weaponized the very structure of globalized capital, proving that money moving fast enough could effectively blind the authorities tasked with tracking it. This realization forced a fundamental reassessment of how international banking operates. Regulators could no longer assume that a legitimate corporate facade guaranteed lawful operations behind closed doors. The scandal demonstrated that the intricate networks built to facilitate global trade could be seamlessly co-opted to harbor illicit wealth. By intentionally fragmenting its corporate structure across jurisdictions with strict secrecy laws, the institution established a blueprint for evasion that modern financial task forces are still actively battling today. Today, the legacy of this unprecedented financial empire is not found in grand monuments or enduring institutions, but in the sterile, heavily redacted pages of the Sandstorm audit. Those archived files serve as a quiet, enduring warning. They document the exact moment the world realized that the most dangerous threats to global stability do not always arrive with standing armies, but can be quietly built within the hidden columns of a corporate ledger.